Howdy, everybody. Welcome to Liberty Call for today, which is Wednesday, March 12th, 2025. Hope you're having a fantastical day out there in the interwebs. It's a pretty nice day here. It's not too hot, not too cold. Lots of sun, a few clouds, but, can't complain. Hope you're doing well out there. Well, the markets are rebounding as inflation cools, with the CPI rising just 2.8% in February, lower than expected, boosting hopes that price pressures are easing. Well, we'll see. The S&P 500 and NASDAQ are gaining, though trade tensions remain a major concern. Trump's new 25% tariffs on Canadian steel and aluminum are fueling fears of broader slowdown, keeping investors on edge. Meanwhile, Intel is soaring on news of a potential joint venture with TSMC, and Adobe is set to report strong AI-driven earnings. So before we break all the news down, I need some help from you. If you could give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All righty, well, let's hop into the markets. Dow Jones was down 0.2%, 82 points, closed at 41,350. S&P 500 up 0.44%, 24 points, closed at 5596. NASDAQ up 1.22%, 212 points, closed at 17,648. The VIX was down 10.85% today. It's at 24 flat. Canada up 0.72, Brazil up 0.26, and Mexico up 0.93. Over to Europe, Germany was up 1.52%, the UK up 0.53%, France up 0.59%, Netherlands up 1.07%, Spain down 0.57%, Italy up 1.61%, Switzerland up 1.49%, and Portugal up 0.36%. Russian exchanges red today. MOEX down 0.57, RTSI down 0.63. And the overnight markets, the Nikkei in Japan was up 0.07, Australia down 1.32, New Zealand down 0.8. In China, the Shanghai was down 0.23, Shenzhen Component down 0.17, China A50 down 0.22, DJ Shanghai down 0.15, Hang Seng down 0.76, and the Taiwan weighted down 1.73%. Why did I do that? I clicked the wrong thing again. Keep doing it. Keep doing it. Not a bad habit. All righty. Well, it's not it. There it is. All right, let's get to the market recap. S&P 500 climbs as traders weigh soft inflation data and tariff uncertainty. The S&P 500 surged on Wednesday as investors reacted to a softer than expected inflation report and ongoing tariff tensions. The U.S. consumer prices increased 2.8% year over year in February, down from 3% in January, and below the expected 2.9%. Core CPI, which excludes food and energy, rose 3.1% annually, also slightly below forecasts. On a monthly basis, CPI rose 0.2%, easing from January's 0.5% gain. The slower inflation rate could reassure the Federal Reserve officials who are closely watching the impact of Trump's tariffs on inflation. Jefferies analysts noted that while the report won't significantly change Fed policy, it supports their patient stance on interest rate adjustments. Trump's expanded tariffs on steel and aluminum took effect on Wednesday, sparking global retaliatory measures. The European Commission plans to reinstate tariffs on U.S. goods worth 8 billion euros starting April 1st and impose additional tariffs next month on 18 billion euros worth of U.S. exports. Trump responded by threatening higher tariffs on EU automobile imports. China and Japan issued warnings about potential economic fallout, and Canada initially planned $30 billion in reciprocal tariffs, but later dropped the plan after Trump backed down from his trade threats. Moving on, Intel shares rose 4% following reports that TSMC proposed a joint venture with NVIDIA, AMD, Broadcom, and Qualcomm to take over Intel's struggling foundry business. The deal, requiring Trump's approval, would allow TSMC to operate Intel's U.S. factories while limiting its ownership stake to less than 50%. And finishing up, Amazon climbed 1% as the Federal Trade Commission requested a 2-month delay in its lawsuit, which accuses Amazon of misleading consumers into signing up for Prime subscriptions. All right, so that is the news. Let's dive a little deeper into the February CPI report from First Trust. Mr. Nate Gursey put it together. Inflation came in lower than expected in February, but it is unlikely to change the Federal Reserve stance on rates. Consumer prices rose 0.2% for the month, below the 0.3% increase economists had anticipated. On a 12-month basis, inflation slowed to 2.8%, down from 3.2% in February of last year. While the 0.2% monthly increase was the smallest in 4 months, it still translates to an annualized rate of 2.6%, which remains above the Fed's 2.0% target. Key inflation drivers, energy and food prices both increased 0.2%, matching the overall inflation rate. However, these volatile categories have not been the main contributors to persistent inflation. Core inflation, including food and energy, also rose 0.2%, bringing the annual reading down to 3.1, still above the headline number. Housing rents increased 0.3%, continuing to be a primary driver of inflation, although not rising as quickly as in recent years. Some analysts, including the Federal Reserve, have suggested that housing inflation may be artificially inflated due to measurement issues. A key Fed-watched inflation measure, supercore inflation, which excludes food, energy, goods, and housing rents, increased 0.2% in February and is up 3.8% in the past year, running hotter than both headline and core inflation. So what's next for the Fed? Despite the slight improvement, inflation remains above the 2% target. The Fed is likely to keep rates on hold until there is a clear downward trend in inflation or a significant economic slowdown. 1 month of better data isn't enough to shift policy. Totally agree. All right. Next up, got an article from Zero Hedge, Silver as a Hedge Against Market Chaos, written by Adam Sharp of the Daily Reckoning. Let's see what he has to say. The recent stock market crash was widely blamed on Trump's tariffs, but the real issue is overvaluation. U.S. stocks are at record high valuations, leaving them vulnerable to any economic uncertainty. Tariffs may be a factor, but the broader issue is that stocks were priced for perfection, and perfection rarely lasts. Historically, gold and silver perform well when the stock market declines. During the 2000 to 2008 bear market, gold and silver miners outperformed tech stocks by a wide margin. While the NASDAQ fell 77% from 2000 to 2002, gold mining stocks rose 13% in the same period. Over a longer stretch, gold miners surged 393% between 2000 and 2008, while the NASDAQ dropped 27%. As bubbles pop, investors often rotate into hard assets like gold and silver. Part of this is due to central banks printing money in response to a market crash, which tends to boost precious metals. In the current market resembles the 2000 tech bubble, with expensive stocks driven by AI hype that is yet to translate into real economic value. While AI may be transformative, it won't prevent market corrections. Gold remains a solid hedge, but silver may have even more upside. If silver breaks above $35 an ounce, it could rally up to 50 and beyond. Silver mining ETFs are already climbing, with SIL up 3.5% and SILJ up 4.9% in a single day. As tech stocks pull back, investors searching for alpha could fuel a major rotation into precious metals. Even a small shift into gold and silver could drive explosive price gains. Given current market risks, holding 15% of a portfolio in gold and silver provides strong risk protection. Certainly not terrible advice there. Anyways, all righty. Last up, we got an article also from Zero Hedge. Is a strategic reserve bad for America and crypto? So we've heard a lot about that in recent weeks about the crypto reserve. So let's see if this was written by Omid Malikan. So let's see if they think this is a good or bad idea. All right. President Trump's announcement of a Bitcoin reserve may have been less ambitious than some hoped, but even a limited reserve is problematic. The government will not sell its existing Bitcoin holdings and will explore a revenue neutral, and that's in quotes, way to acquire more, but this entanglement between state and crypto is a mistake. The U.S. does not need a Bitcoin reserve, and creating one undermines financial neutrality while sending worrisome signals about the stability of the dollar. Worse, such government intervention distorts the free market, allowing politics to dictate winners and losers. Trump's broader pro-crypto stance is commendable. His first executive order on digital assets rightly focused on establishing a regulatory framework rather than direct government involvement into crypto markets. Sensible regulation can protect innovation, jobs, and tax revenues without interfering in free market decision-making. However, some in the crypto community pushed for direct Bitcoin purchases, a move that contradicts the technology's ethos. Blockchain and Bitcoin were designed to create a decentralized, neutral financial system. Government ownership could corrupt these principles, leading to manipulation, insider trading risks, and market instability whenever administrations change. Trump's initial social media post hinted at including smaller, obscure cryptocurrencies in the reserve. Some of these coins spiked in value immediately, giving bad actors new ammunition to manipulate markets. Even the quote revenue neutral end quote approach raises questions. Who decides the price? Which exchange will handle the transaction? Who will custody? The government's involvement could easily become a tool for financial coercion. With the U.S. running trillions in debt, every dollar spent on Bitcoin could instead pay down deficits. A Bitcoin reserve does not enhance U.S. leadership in digital assets. It compromises both government's neutrality and crypto's decentralization. A true free market approach would let users and markets, not politicians, determine Bitcoin's role in the financial system. I agree. We should keep the governments out of it. Just let the system work as it is, and let it be a free market of exchange. So. All right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a ring. I'd be happy to help. All right. Well, I hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.